we turn farmland into new affordable housing communities. And so we
Hmm.
do that by way of getting that approval in place while we have it under contract. While it's under contract and we get all the approvals, then we can go and line up a buyer. We can line up the funds. So I really like it because it's kind of unique. There's some pretty good risk mitigation characteristics of this type of investment that make it attractive.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back, Decoding Cash Flow listeners. I'm your host, Ted Patel, and today we have a great guest, Brandon Cobb, who is a CEO and co-founder of HBG Capital. Brandon has carved out a niche in residential and commercial development, especially in the land development business. And he has been helping investors achieve outstanding returns through strategic real estate investments. After starting in medical sales, he transitioned into real estate and built a thriving business, uh, especially in, as I said, new construction, build to rent, land development, and other high yield investment opportunities. So, Brandon, with that said, welcome to Decoding Cash Flow. It's a pleasure having you on the show.
Yeah, it's a pleasure being here. Thanks for having me.
All right. So, Brandon, before we dive deep into what you're doing right now, can you give our listeners a little bit background about what you did before you got started into real estate?
Yeah, well, if you told me 8 years ago that we'd be inventing these new communities, I would have looked at you like you had eight heads. So I never had a desire to be an entrepreneur, believe it or not. In fact, my dream job was medical device sales. And after years, I finally broke into that job. And like a lot of people, especially, young guy in his early 20s, coming out, getting a first career, all I wanted to do at the time was make my parents proud and do exactly what the path that they had laid out before me was, which was go work for a good big corporation, get a good paying job with benefits, save your money, don't spend. And, one day, Brandon, 30, 40 years later, you can retire. And I was on that path. I was doing that path and I was perfectly happy. Young guy getting to be in surgery every single day, rubbing shoulders with orthopedic surgeons, wearing scrubs. I mean, I thought I was the coolest kid on the block. And that was my dream job. I did not have any other aspirations. I loved what I did. And then one sunny Friday afternoon, it happened. I was having one of the best days of my career, excited to give my boss the good news. I was sitting across from him at Starbucks. And before I could tell him how great of a day I'd had, he fires me.
Uh-oh.
And the shock that I felt from that, because I lived, breathed, and ate that job. I loved what I did for a living, and even more importantly, I saw my boss as like a mentor. He was like a father figure to me. He was the guy that let me into the industry, got me my dream job for the first time, was teaching me all these things, and so like anybody who loses their job, it's not just losing a job. I was losing a lot more. I kind of felt like I was being abandoned that day by him. And I had my whole identity wrapped up in being a medical device sales rep. Right. And so I wasn't just losing a job that day, I was losing my identity. And so, after the shock wore off from that, I said, okay, well, I've done a good job of living below my means. I've got some cash saved up. Let's give this entrepreneur thing a shot. So I set out to go and start my own business. I had no clue what I was going to start. I had to sell a course on how to break into medical device sales. I said, well, I've got a background in this. Maybe this will be good. I can teach people how to do it. That failed. I thought I wanted to be the next Tony Robbins because I really like Tony Robbins stuff. I said, I'll be a life coach. Well, Ted, it turns out not many people want to take life advice from a 27-year-old, believe it or not. And I love motivational stuff, so I started a motivational blog that failed, and then I discovered this vehicle called real estate, and that was the first thing that I made money on. I sold all my retirement accounts to purchase this house that I ended up flipping. I flipped it, and a few months later, I made like $30,000. And that was the first time I'd ever made money myself. And I'd given myself a 6 month ultimatum from getting let go from my job. And in that 6 months, I said, hey, worst case scenario, if I fall on my face, I can always go back and get another job. I was comfortable with the worst case scenario. And that $30,000 helped start the business that would eventually become HBG Capital. So, you fast forward to today, we've done everything from create our own general contracting company to, source all of our own off market deals to, raising capital for our deals. And, now we invent new communities that are catered to that first time home buyer. So we're the ones that'll go in and get the land approved for the community and do all the infrastructure work to get it ready to build houses on.
Awesome, man. That's great. That's great. Very motivational story, but as you know, right? After your job, you tried few things, but that's the learning curve, right? It's not like it got wasted. I'm pretty much sure whatever you did, it did help you in your further endeavors.
Yeah, 100%. I mean, the
Yeah.
skill set that I took from that was invaluable. And the whole reason I tell this story, real estate, that, as you know, is a fantastic tool to
Yeah.
pursue whatever you want to do in life. I see it as a tool to build unique life experiences with
Yeah.
those that I love. Like I see real estate as a tool to do that. And it's enabled me to take, 5, 6 weeks off a year, travel, go do fun stuff. I do an annual mom son trip every single year where, she's a history teacher. She taught history for 25 years, but she could never afford to travel and actually go visit some of the places. So we just got back from San Antonio a few months ago, visiting there, the Alamo. The year before that, we were in, Charleston, South Carolina, Savannah, Georgia. So it's this amazing tool that really can allow you to build the life that you want to build. And the reason I tell you that is somebody listening to this might be climbing the corporate ladder somewhere. And I just don't want somebody to spend 20, 30 years climbing the ladder just to realize that they're a number and they get let go and everything that they'd built is just
Yeah.
gone in an instant. And they didn't take the time to start investing and creating their own financial freedom. That's what that was the big lesson that I learned that day was
Yeah.
nobody was going to look out for my financial freedom but me.
That's very true. And the real estate is one of, I would say, the one of the best segment where you can start a side hustle while even you're working 9 to 5. And once you have stabilized that, once you know the income from your real estate business exceeds your current, salary, you can always make a pivot, jump to the other side of the fence, and be independent. As you mentioned, it gives a lot of freedom, right, to do whatever you want. You're not tied up, listening or following orders, and you have more stability in life.
Yeah,
Yeah,
and it's not easy either, as you know, but it's worth
yeah,
it.
worth
It's
it.
worth
Yeah,
it to go through it and actually try to build whatever it is that you're trying to build. And like I said, I didn't know what the heck I was doing when I first started out, and a lot of people listening might not. You know, you don't necessarily have to quit your job either. You don't have to go all in like I did. And
yeah,
I say I burned the bridges, but I didn't light the match myself. Somebody else lit it for me, and I found myself unemployed one day. But you can start. A lot of people start as, limited partners and investing in great operators and companies like yours, and they can learn the ropes that way. And some of them go, you know what? I've got my own business and job, and I'm good with that. I don't want to do it, and they can just dump their money as a limited partner, and eventually they can have the cash flow that they need to live off of, and so they don't have to technically work. So you don't have to take the plunge if you want. You can
yeah.
definitely do it if you still got a job or you own your own
Yeah.
business.
Yeah, you don't have to be active investor as you mentioned, right? It's always the passive side can, uh, backfill your lifestyle.
Yeah.
Yeah. Right. So now, moving on to HBG Capital, can you tell us more about this company? Like what exactly you focused on? What are your current investment strategies?
Yeah, so we have identified affordable housing as a sector that's going to do really well the next 3 to 5 years. And when I
Mhm.
say the word affordable, I'm talking about little a, not big A. Big A is affordable as in Section 8 or government housing. We're not doing that. Little a affordable. We're focused on that first time homebuyer housing product because, as you've probably seen on the news and a lot of people have heard, there's an affordable housing crisis here in the United States. They're not talking about Section 8 government housing. They're talking about you've got over 34% of the home buying population, which are millennials, that have been at prime home buying age. They're having kids for the first time, they're settling down, they want to buy a home, but with interest rates and rising costs of constructions, it is extremely difficult to find that product. And what am I talking about here? I'm talking about that $2,500 per month or less mortgage. That is what people are chasing. And if you look at that, that's a home priced in the mid 300s. And that's
Mhm.
just very difficult to find. So if you're able to supply that product, there's more demand chasing supply. And I'm not a genius or anything. I just see that there's more demand for that product than there is supply. And so that's where we want to be. So
Mhm.
what does that look like? Well, our background is in construction. We started building a lot of houses and we realized that we could really do this at scale if we found the plots of land and got the community approved instead of going around trying to chase these onesie twosie little single builds here and there. And all of a sudden you got 30 builds going and you're spread out all over town. That's not what we do. We go to the cities and we pull up a chair on the same side of the table and we say, hey, what's lacking in the community? What do you guys need? What is that? What are some of the developers that have done a really good job to work hand in hand with the community? And what are some things developers have done that put a bad taste in your mouth that we can avoid? We want to build a relationship. We
Mhm.
because the city needs developers and the developers need the city, right? The city needs developers to be able to create the vision for the community, and they have that. So we go in and we identify those parcels of land that are not the highest and best use, and we work with the city to get them approved.
Okay.
I'll sum it up in one sentence. We turn farmland into new affordable housing communities. And so we
Mhm.
do that by way of getting that approval in place while we have it under contract. While it's under contract and we get all the approvals, then we can go and line up a buyer. We can line up the funds. So I really like it because it's kind of unique. There's some pretty good risk mitigation characteristics of this type of investment that make it attractive that I couldn't get in other types of investments. And so that's one of the reasons that I really, really like it. But that's what we do. And we'll a lot of times we can develop this land and we can build the houses. But what we found is that these national home builders like Lennar and DR Horton, these are publicly traded companies that
Mhm.
have to grow. They have to hit their IRR numbers. And if they don't, well, stock goes down. So they need the machine to get fed. And we could either build houses and compete with them, or we could be on the side of the table that Wall Street is cutting checks to. And they've got an unlimited pocketbook and they can write as whatever number you want on that check if you can give them enough land. And so that's
Mhm.
what we're doing is we go in, we get the approvals in place, we put the roads, the utilities, the infrastructure in, we pre-contract with a builder before we do all that. So it's pre-sold before we ever stick a shovel in the ground or raise any money. And once it's finished, we sell it to these AAA rated national home builders.
Awesome. Well, that's a great business, land development. And you know, maybe because we are also into new construction over here in New Jersey. We build luxury single family homes as well as small multifamily properties here.
Mhm.
But this is a different segment, this affordable housing, the price point that you mentioned, right? It's very hard to find here in Jersey, Eastern, yeah. So yeah, it's less land available, of course, but yeah, it's a very promising segment of the real estate where I would say, you have minimum investment, maximum profit,
Yeah, you
right?
guys have the density. That's the problem is you can't
Yeah.
find any land to do this with. We got land that stretches far, far and wide. There's so many people that have moved here from New Jersey, New York, California,
Yeah.
because they've realized they can get twice the house, twice the yard for half the price,
Half the
or maybe
price.
even get a yard where they don't even have a yard in New Jersey. It's interesting,
Yeah.
different markets.
Yeah. Different markets, of course. So, as you mentioned earlier, right? You sit down with the town. So, does town help you identify the lots or the property, or you just uh, go and find a farmland near to the suburb or the developing area? You put that in the contract. How does it work?
Yeah, so most of what we do is we're reaching out direct to the potential homeowners.
Okay.
And it's a very easy conversation because we are providing so much value to them. Their property is not worth what we could pay for it. In other words, when we're contacting these sellers, hey, you ever thought about selling? What's a number that would put a smile on your face? Okay, well, here's how we're going to get you to that number, because everybody always asks for more than what the property's worth, right? When we explain that we're going to force appreciate the value of the property through this rezone or approval process called entitlement, that catches their ear. Oh, you're going to make my property more valuable for me? That's how you're going to be able to pay me so much money? Oh, interesting. We had a lady who, property wasn't worth more than $400,000, 20-acre farm. We gave her $700,000 and got it approved for 74 houses. She was ecstatic. And we were ecstatic because we got a really good deal. So we reach out directly. The reason we meet with the city beforehand is it's a relationship business. You want to have a good relationship with the city. If you're somebody who's just showing up for the first time for a preliminary plat approval and you're asking for things, a lot of times it might not go over well, right? But if you've approached them beforehand and built a relationship and done a needs assessment, like, hey, how can I help you? And listen to that. And they might say, hey, we want some green space. Hey, we really need some houses that are nicer, that are not, these builder, grade homes, or whatever the needs are. If you can incorporate those into the deals that you're bringing them, now you've caught their attention. We had a parcel where the had we just shown up and tried to maximize density, which is what a lot of new developers do, let's just put as much crap on there as possible because it'll be worth more. We went to them and they said, hey, we really want commercial along this corridor here. And so that's what we did. So we lost out on some of the residential, but we got the commercial piece of it. And they were actually willing to work with us on the residential and make it more dense than what their original zoning allowed for. We did a PUD, a plan unit development, instead of going with what the zoning was there. And so we ended up getting a little bit more density out of the residential piece. So that'd be an example of listening to the city's needs and understanding what those are. Because that city, one of the things they want tax revenue. And they don't get as much tax revenue from the residential homes through property taxes as they do the sales taxes through the commercial properties. That was something that we learned. So the cities really, really want commercial for that reason. And again, sitting down with them ahead of time and understanding those needs and being able to come and present something that meets those needs is so important. It's a complete game changer. So that's why we recommend meeting with the city regardless. If you can, in a place like New Jersey, it might be kind of difficult to meet with the decision makers because it's a big, metropolis, depending on what kind of city you're dealing with. But a lot of times you can go and you can talk to somebody who works at the planning and get their opinion.
And how do I identify these parcels? Like, what are your specific criteria to identify them?
Yeah, that's a great question. I call it hunting the giant puzzle pieces among the small puzzle pieces. If you've ever pulled up a parcel map, and it shows all the land. It all fits together. It's all a puzzle piece, right? It perfectly fits together. We start in the communities that our buyers are in. Our buyers are national home builders. So we go where they're already building. And when you pull up the parcel viewer, you can see the neighborhoods they build in because it's a lot of small little parcels all condensed in one area. That's a neighborhood. And you're looking for the giant puzzle pieces that don't have the density around all the smaller puzzle pieces. I know that if it's near, one of the main roads that there's a community on, it's probably got sewer access. I know that if a national home builder is already building there, that other national home builders probably want to be there too. And I know that they want to be there. So I've got my buyer lined up. And it needs to be in an area that's preferably around something, right? And so something it's not out in the middle of nowhere. We've got access to sewer, preferably. We've got access to some kind of coffee shop. Is it 5-10 minutes from a grocery store? It's got to have something going on, right? And typically, if you're finding these new communities being built, that's already a requirement that's been fulfilled. But that's essentially how it works.
So, just to summarize what you said, right? What you do is identify the parcel, negotiate with the owner, put the land under the contract, go to the city, get the entitlements, develop the land, bring in the sewer, electricity, water, whatever is needed, build the road. And before you build the roads or do these things, you sign up a contract with the builders, right? And
Yeah, you kind of hit it. What I really love about this particular business, 'cause I've done a lot. I've flipped a lot of houses. I've owned rental properties. I've invested my money in multifamily syndications and self-storage syndications. I still like that, by the way, too. The depreciation's awesome.
yeah,
I've done a lot of things. I've built houses. What I like about this is I can force appreciate the value of the asset before I buy it. We
yeah,
put it under contract with the seller, contingent on the outcome that we want. And if we can't get those terms, we just don't do it.
mhm,
Period. So
yeah,
we force appreciate it before we buy it. So when we buy this property, we're walking into a ton of equity on day one. So there's
mhm,
two force appreciation plays with the asset. One is getting it approved for a new community, turning the farmland into a new housing community approval. The second forced appreciation play is when we go and we put the roads and the utilities and the infrastructure in. So there's two ways that we can force appreciate this property. And what it does is it gives us multiple exit strategies. I'll give you an example. So there's three, four things we can do to get out of this piece of property. One, there's a bunch of development going on around this piece of land. I think we've all driven that neighborhood that was developed, and there's that one house or that one building that like didn't sell that's really old and it just sticks out. If we're that type of parcel where everything around us being developed and we've bought it, we'll actually just land bank it. We might not even develop it. We'll just buy it with 100% equity from
mhm,
our investors. So there's no debt on it. And we just own that asset. We'll hold it for maybe a year, 2 years, 3 years, wait for all the development to finish around it. And then we might just sell it to another developer or builder and make a lot of money on it. So we've already forced
mhm,
appreciate it through that approval, and we know it's going to be worth a lot more when all the rest of the development finishes. So that's exit strategy number one. Or we could buy it with investor equity and line up a builder while we're taking it through all the approvals. So we take it all through all the approvals, we line a builder up, we force appreciate it, we buy it with 100% investor equity, no bank risk. And then if we have a builder partner, then we could take that equity and at that point introduce, a bank loan to go and get the lots developed. And the great thing is we get these 10, 15% deposits from these national home builders. I got a $10 million deal that I'm doing with D.R. Horton. They're giving us a $1.5 million deposit. It only cost me $4.5 million to develop that piece of land. So I'm getting 30% of my construction costs from the builder for free,
mhm,
$0 interest. They just want get the lots when they're finished. And what that does is it creates this unique situation where a lot of times when we go get bank debt, we're below 50% loan to value because we've received this large deposit
yeah,
and just don't see a lot of real estate deals where I can go to a bank and get less than, 40, 50% LTV sometimes. I mean, especially if we convince the owner to contribute the land as equity to the deal, make them an investor in it. We give them a buyout option. Hey, cash price once it's done is this. Or if you want to stay in the deal, I can offer you 50% more. That raises some eyebrows. And so I like the fact that we can, one, just land bank it and sell it, or two, pre-sell it to a builder and develop it and sell it. And the third, if for some reason, the builder backs out or I don't know, something goes wrong, we're stuck with a bunch of lots. We're builders. We can build the houses and exit. So we can also do
mhm,
that. And then a fourth exit strategy is we can actually rent the homes out, build to rent, though that strategy has become a lot more difficult since interest rates have gone up.
hmm. All right. So, to develop the land, uh, do you get the funding from the banks? Of course, if you have a contract with the builders, as you mentioned, they will give about 25 to 30%. What about the other part? Do you do it from the bank or is it the investor's money that you put into that?
We've done a model where both. Like sometimes we're able to raise enough money where investors are all in a first position and they are debt on the deal.
Hmm.
We had to do that after rates went up because it became so much more difficult to get financing from banks. So we're doing less deals because we had less investor equity to deal with. Same amount of equity, but less deals. So we've done it that way. We've done it where we just buy the land as with equity and maybe raise a little bit of additional equity and then get the remaining financing needed through that deposit with the builder and financing. So there's a lot of different ways that you can do it. But typically I'm I'm focused on six main ways to reduce risk, especially since rates went up and the market's been correcting. One is having those multiple exit strategies that we talked about.
Mhm.
Two is being able to control the debt. I'm not a big fan of going to banks. If I do go to banks, I typically want to get my own terms, which means I will go to a bank, and if we expect to be in and out of this deal in a year and a half, I'm going to get a 3-year bank note and I'm going to prepay all the interest up front so that I don't have
Mhm.
any monthly payments and I'm nice and liquid and I've got that set up. So being able to control the debt in some way, shape, or form, very important. We've gone private routes where I get better terms. I pay a little bit more for it. But again, I either just don't have those monthly interest payments. That's the key, is to stay liquid, not have that. I want to
Mhm.
have the ability to hold the asset long term. So that's where we talk about land banking it if need be, or holding it all through, building the houses, or doing the build to rent strategy. You got to be able to hold it through these downturns. We bought a piece of land in October of 2022. Worst time ever because all the builders flocked to the sidelines. Nobody bought anything in 2022 because rates were now at 6.5%. And so worst time to buy it. But we bought it with 100% investor equity and we
Okay.
held it for a year and a half. The market turned around. The builders came back. We got a great deal on it. We weren't forced to sell it. And so we developed and ended up selling that property because we structured it in the right way. So we want to have the ability to hold it.
Mhm.
You want to have forced asset appreciation as well. And, like the multifamily world where you renovate and, maybe make the business a little bit better, cut costs, increase the NOI. We force appreciate it through that entitlement process or that rezone process, getting it approved. And then the development portion where we're going in and we're actually putting the roads and the infrastructure in. So we've got two different ways of force appreciating. That helps reduce risk. The fifth way we mitigate risk is having a buyer lined up before we ever raise any money or do anything. And not just any buyer, a household name like Lennar or DR Horton, AAA rated, national home builder.
Mhm.
And then the six is we always build in a lot of downside protection. So, I'll give
Mhm.
you a deal. We had 74 houses, lots that we were developing for a builder. We're in it for about $9,000 per pad when we got it approved. The development cost on it were 52, 53,000. So we're all in it like 62, 63. We contracted to sell those 74 lots for 85 per pad. So
Mhm.
I've got like 21, $22,000 of margin on an $85,000 deal. That's roughly 25% decline in value that we could stomach before everybody breaks even on the deal. I
Mhm.
like that. The asset can decline 25% and we're still okay. We break even. We live the fight another day. I like those. I like that downside. So those
Mhm.
are some of the ways that I'm really focused on mitigating risk. And this is an asset class that allows us to do that.
Yeah. And did you come across any instance or any scenarios where you had a property under contract, but it didn't went through? Any such
Oh, yeah. We
instance?
had one
Yeah.
under contract. We got the preliminary. Okay, this is why you don't. Rule number one is never buy anything without the approvals,
Yeah.
unless you could have those approvals fall through and you could still get your money back. In other words, if you're buying the land for the as is value without the community being approved, and you have that fail, and you could put it back on the market and maybe
Sell it
make a
at the
little bit of
market
money
rate.
or
Yeah.
you get back. You can do it in that case, right? Because your downside's mitigated.
Yeah.
We had one where we got it past preliminary plat approval. We got it through. In this municipality, sometimes with the city, they don't know everything. These are elected citizens, and sometimes they're just figuring things out. Well, further down into the approval process, they're like, "Oh, we want a turning lane. What turning lane? What a turning lane? Well, what do you mean? What kind of turning lane? Like, you didn't bring this up initially, and that turning lane's a $1.2 million turning.
Wow.
Well, this deal doesn't make sense anymore. That can happen a lot, and that's why it's important to do everything while you're under contract, not while you own it. That's one of the things that we do.
So on an average, right, when you put any deal under the contract, what are your soft costs before you uh, start developing the land, let's say?
Yeah. Yeah, that's a great question. There's several stages of due diligence that we go through depending on where we're at.
Mhm.
First, and what I tell people is, look, all you need is to spend maybe $1,000, a couple $1,000, and get a concept plan from a civil engineer before you do all this work. So you can put it under contract with the seller, get your concept plan drawn up. In other words, hey, based on the zoning or what I think I can get, what does this community look like? How many homes? Doesn't take much time. You can take that to the city, go meet with your planning commission, go meet with your council members, go meet with the planning director and say, hey, this is something that you guys would support. And again, you've already met with them. So you know what they're wanting, and you've built that into the concept plan. And you can get, if you get verbals from enough people, you know, okay, this is worth my time. And at that point, you can start the first real leg of due diligence, which is getting your geotechnical report. This identifies what are the soils. Are the soils good? It identifies, are there any rock? Rock equals you're going to spend a lot of money. So identifying that. Phase one environmental. You want to make sure that there's not like a toxic waste dump on the site, nothing crazy. Some commercial sites that have, oil changes from car places or a business that might have some kind of seepage into the soils, that might be a problem. So you get a phase one environmental. And, then at that point, you're probably good to go and get all your preliminary plats done. Once you've got a preliminary plat approved, that means they've stamped this mock community that you have on paper and said, yes, we want this. That's when you're going to start spending a little bit more money. That's when you actually have to start paying for the civil drawings. This is a civil engineer designing the roads, designing the sidewalks, the slope and the grade, where the utilities are going to go, how deep are the utilities going to go, how does it connect in with the city utilities, and you're going to spend some money there. You could spend anywhere from 40, maybe 30,000 on a smaller project, like 30, 40 homes, all the way up to, you could spend $150,000 if you got like a 500 home, community. So there are some costs that would come out of pocket, and we take that risk once we get to that point with the seller where it's approved, because we've got an idea whether or not it's going to pencil, right? We've done enough of these to know, but those are the costs that you're going to deal with as you take it through the approval process.
And when you approach the home builders, what's your strategy to pitch your your property to them?
Oh yeah, it's great. So we've already sat down with all the builders before we did anything. When we were
Okay.
doing this, we sat down and we got their buy box. These
Okay.
national home builders all have a product, and they will not change that product at all. You have to make sure that your land can fit that product. For example, every national home builder has like a 22-foot wide by 50-foot long townhouse. So if you're doing a townhouse development, that's what you want it to be, right?
Hmm.
And so you know what product they've got based on your research, what they're building in
Okay.
the area, the conversations that you've had with them. And so you're going to design that community per the national home builder specs. It's not that hard to figure out. Anybody can go talk to them or look it up, and you just want to make sure that it can fit their product. And as long as their product can fit on each of those lots, then you're okay.
And these big builders, right? What what's the leverage that you have that they don't have? Like they can go in the community, buy the land themselves, develop it, right?
Yeah, they've
Where,
got sales reps. Yeah, they got sales reps that are out there fighting every single day,
yeah.
but they're overworked. There's so
Okay.
much turnover at these national home builders. I joke that when somebody leaves, I don't know many people that get fired. They all leave. When one person leaves, all the managers from all the companies perk up, because when that person leaves, they know that that company that just lost that person is going to take a person from another company, and then that company is going to take it from another company. They all these sales reps and managers, all they're doing is just switching positions at these national home building companies for an opportunity for growth, for a promotion and better job. And so there's a chain reaction every single time somebody leaves. There's a lot of different people that end up leaving, and new positions kind of scoot around. It's kind of funny to see once you've been doing it for a while. Needless to say, these sales reps, they also have to spend the time getting things approved. Usually, that's like usually in their scope of work. That's a lot of time and effort. And so they love it when people bring them deals.
Hmm. Okay. All right. Now, as you mentioned, you also raise capital for these projects, right? So,
Mhm.
what are your main strategies to raise capital, attract the investors on these deals?
Yeah, that's a great question. So, we've built a pretty good reputation with our current investor base. We've taken care of them. So, every time there is a return of capital, we always interview them to make sure they're pleased, they're happy, and we ask for a referral. So, we've got a really good referral system that's set up and running. We do
Mhm.
a lot of content generation. I've been writing every single day on social media for years, all with value added content for our target avatar, which are 7-figure business owners. We just like 40% of our investors are very, very successful business owners that don't want to be in real estate. They want their money to be in real estate. They want to do their business because that's what makes them money. And they want to invest their profits into real estate that then pay them money. And so we create a lot of content for 7-figure business owners. And that's who ends up usually seeing something either on our podcast or our social media posts or on a podcast like what you and I are doing. I do a lot of speaking engagements. That's been very successful. There's not one specific strategy that I'd say, "Oh my god, this is the one. This is the secret." Everything works. It's just how well are you going to execute on one particular niche and have multiple streams open for raising money. That's what's worked really well for us.
And are these investments based on 506B, C? What kind of or a fund model, fund of funds? How does it work?
Yeah, that's a great question. So we typically do syndications, though we'll probably end up doing a fund. I think at some point this year, I think we're kind of to the point where I'd like to do a fund. But right now it's syndications, so we raise deal by deal,
Okay.
as it is right now. And we've done 506B, 506C. It all just depends when people catch us, right? If they're catching us during a raise, or we don't feel like we've got the relationships lined up, then we'll do a 506C. But we've got a lot of relationships. Like I meet with every single person that's interested in our company. We don't talk any investments. Like they find us, I meet with them face to face. I get to know them. We build a profile out. There's engagement afterwards. Like I build a relationship with every single person that I meet with. And so, for that reason, we're able to do a lot of 506B when, other people can't.
And how is the return on investment structured? At what point of time you start giving out, uh, you know, I'm sure there's no cash flowing here, but at what point
Yeah.
of time you return the money to the investor, or you keep rolling the money in the next deal? How does it work for you?
Yeah, that's a great question. So yeah, and I always talk about some of the downsides. Some of the downsides, and one of the reasons why I love multifamily is there's no depreciation. You can't depreciate the land or the stuff you're installing. It's a much shorter deal cycle as well. We're typically in and out in 18 months or less on a
Mhm.
lot of these deals. So that's one. The other is the cash flow, right? We don't have renters paying us monthly, and so cash flow occurs once the lots start selling. But we typically have done an 18% preferred return, and that's a 100% waterfall to the investors. And once they're paid out of the deal, then at that point, the GPs can start profiting and making money. That model's worked really well for us, and I see that we'll probably continue it in the future.
Awesome. Hey, Brandon, loving this conversation, but also want to be mindful of your time. So before we get to the final round of questions, is there anything else you'd like to tell to our listeners?
You've done such a wonderful job with the interview and pulling all the information out. I people listening to this, I'd say that it's funny, if you're interested in land, if you're interested in becoming a land developer or investing in land, whatever it is, all real estate starts with the land. You
Yep.
got to think about that for a second. Whoever controls the dirt controls the deal. And if you can figure out that portion of the real estate transaction first, you can literally go and build whatever you want. That's one of the most exciting things that I get to do is bring these new communities to life. It's pretty cool.
Awesome. All right, Brandon, let's jump to the final round of questions. Are you ready?
I'm ready.
All right. So, which is the one book that had the most impact on your life or on your business?
This is interesting. There's so many because I love to read. I don't know if you can see my library behind me. I'm a very avid reader. But the book Think and Grow Rich is what really changed my life. I didn't read it while I had a business. I read it in my early days while I was in college, and it completely changed my whole perspective on life. I saw myself as a victim and everything was happening to me. And I read that book and realized that I can create the life that I want. It's all up to me. And things aren't happening to me, they're happening for me. So that book will have an effect on I think whoever reads it.
Yeah. It's all about mindset, right? You put it in the right direction, you set the sail in the right direction, and that's it.
That's right.
All right. What are your main source of information to learn and grow?
Books and YouTube. I'm obsessed with YouTube, but the way I learn best is I find a subject that is applicable to whatever I'm doing and I will latch onto that. So I've noticed that I have to be really interested in something. And if I'm not really interested in it, I'm not going to enjoy learning about it. So I usually tend to focus on a subject that I'm weak in or I don't understand a lot, but it catches my curiosity and I'll just absorb every single book, possible on that subject. Like right now, I'm studying some very large macro trends, some bigger picture stuff. I've been so focused on real estate for so long, and I've got so much of my money that's in real estate. I've been looking at some other asset classes that are not real estate specific, that just diversify and kind of have some fun in. And so I've been watching a lot of these larger trends, especially around digital currency, the whole digitization of our environment, the humanoid robots that are coming, the artificial intelligence. Like I'm just obsessed about this whole exponential age thing. And I'll kind of tell you the particular subject. Raul Paul, he runs a website called Real Vision, and I just love his whole exponential age newsletter where he talks about the future of AI and what's coming. Is just so stinking exciting. So that's one thing that I'm like obsessed with right now that I'm reading a lot about.
Yeah, it's always good to learn new upcoming technologies, right? You never know where you can implement it in your business,
Oh, one,
or maybe you can diversify, as you mentioned, right?
or
Yeah,
it'll put you out of your business if you're not making attention to what everyone's using.
that's true. That's true. All right. Which is the one habit or routine that has been crucial to your success?
Working out every single day. So I'm a health nut. I've got a cold plunge down in my basement. I'm wearing my Whoop, as you can see here. I track my sleep. I'm obsessed about eating healthy. I'm about to go have me a green smoothie with a bunch of kale and carrots and fruits and avocados and stuff in it. So being healthy and being physically fit is by far what has done the best for me because it allows me to work longer and harder and more efficiency because I'm when you're when you're physically strong, you're mentally strong, I think.
Yeah,
And you need a lot of mental integrity to be able to go up and fight the entrepreneur journey.
very true. You got to treat your body as a temple, as everyone mentions, right? Yeah.
That's right.
All right. One final question, Brandon. How can Decoding Cash Flow listeners get in touch with you?
Yeah, so if you're somebody who's trying to build a legacy, if you're looking to create cash flow, make an impact, especially with loved ones through real estate investing, and you're interested in diversifying with land and you want to learn more, we've got our own website, hbgcapital.net. It's pronounced Harry Bob Gary Capital.net. And I joked that the .com was taken, so it is .net. But on the website, we've got a ton of free information about what we do. I've got a book called 100 Questions Business Owners Ask Before Investing. I wrote that book because I got a call one day from one of our investors asking if I would be able to help one of his buddies that lost all their money in a real estate investment that they lent money to. And it became very evident early on in that conversation that the reason this guy lost the money was he was green. He did not know how to vet the sponsor. He did not know how to vet the deal. And as a result, he lost all his money. And I left that conversation thinking, okay, if I could just prevent this from happening to one more person, how could I do that? And put together that book, 100 Questions Business Owners Ask Before Investing, because questions unlock the answers we need to make more informed business decisions. If you have the right questions, you're going to have the right answers you need to make more informed investment decisions. So that book's completely free. It's on our website. You can grab it. We've also got our own podcast, Recession Resistant Real Estate Radio, where you can learn more about us and go there. And we've also got our land development mastermind. So, if you want to be an active land developer and, learn how to do this stuff, we've got our own mastermind community. You can go to learnlanddevelopment.com.
Awesome. Brandon, it was a pleasure having you in the show. It was a great conversation today.
Yeah, thank you. Appreciate the opportunity.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.